to and sorry, I've neglected to mention, at any point if I'm not audible, please just let me know. I'll just adjust my mic and stuff. So there's two broad kinds of transactions, right? One is a sell side transaction, one is a buy side transaction. Simplistically, but at a very broad level. A sell side transaction basically involves you acting on the company's behalf to raise funds or to induct a strategic partner. Now, there's again, you'll hear the terms primary, secondary, pre-money, post-money, minority, majority. These are all terms that are encountered in this context. So when you're raising funds for a company, you can do it in two ways. Either you sell shares of the company, in which case it is the shareholders which get the capital. So that is a share sale transaction or a secondary share of sales. So that's one perspective. The other is a primary issuance where you're fundraising. So you issue new shares or instruments to equity investor perhaps, and that is a primary fundraise transaction. When you hear fundraise or M&A, this is what that is. So that is a sell side transaction. A buy side transaction is a converse where you act for the investor. The investor says, okay, I need to invest in this company. Can you help assist me? So the buy side is a very, very different sort of modality. A sell side transaction is a more typically encountered one where a company comes to us and says, look, and you may have all encountered this in your various interactions as well. A company comes to you and says, look, I want to raise funds. So there's two parts to it. What should my valuation be? I think that's the first question half of us here. But more critically, who should I raise funds? How much capital should I raise? Who is the likely counterparty, etc. So the role of an investment banking professional is to solve that. The way we structure our fees is via a success fee, where we say, okay, if the company is asking us to raise, say, 100 crores, we will raise 100 crores from a private equity fund, for instance, and we'll ask for 2% of that or whatever that percentage is. So it's a bit of high risk, high reward. So that typically tends to be the beginning point of a transaction. Now, the problem statement then actually is a bit larger than what it seems to be. So when a company comes to us and says, okay, I am looking to raise funds, what should my valuation be? It is very easy for us or anyone to say, okay, give me your projections. This is your balance sheet. Basis this because of DCF, because of book value, etc. This is your valuation. That is like a half day kind of a work, right? But the way we, from a, say, IB side, we typically begin such conversations is to say, okay, leave your valuation aside. Valuation is the end product. It's not the starting point. What do you need funds for? Is it for growth? Is it for your personal liquidity? If it is for growth, with this money, what is the kind of projections that you are budgeting? So from a project perspective, does it make sense for you to be raising equity money, or will debt money suffice? So while I can get into the details of those parts, if you think that's relevant at a later point, from a transaction life cycle, then the first step that we spoke about is the interaction with the client, where they say, I want capital or I want an investor. But the immediate second part is, what do you need capital for? What is your projections, or what is your business plan with this capital? How do you see this being deployed, etc., etc. We sort of see that this starts the roadmap to a far richer conversation, where we are potentially getting into an investment banking advisory kind of a relationship, rather than a transactional valuation assistance relationship. And we find that A, way more remunerative. B, also we think it leads to more impact, because we're then taking the role of an advisor as opposed to a report giver, so to speak, from a client perspective. So that is the second part of it. Once we understand what the money is being raised for. And this process lasts like a month and a half, where the company shares their business plan with us. We sort of make a information memorandum for them. We make a business plan for them. We give our point of view on their valuation, not as a valuation report that they can file somewhere, but more as a discussion basis the numbers that they've given. I am not getting into the methods and metrics on the valuation side of it, because I mean, this is the expert body already. So I'm just going to skip past that. But the initial preparation stage entails that element as well. Once that is done, once we have a handle on what the use of funds is, what the information memo looks like, what the valuation ballpark looks like, we then go out and start canvassing for investors. We reach out to private equity funds, we reach out to strategic partners, wherever, and that's where each firm has a different way of doing it. From a EY Ernst & Young perspective, we have a global network which helps us, etc., etc. Once we identify a potential sort of investor, we then start discussing terms. Now, terms are large. Start with valuation, basically where we discuss amount of money being deployed, what's the percentage shares you acquire, etc. And it then gets into territory of rights, affirmative vote matters, shareholder matters, that entire bucket of it. That leads to a due diligence phase, that leads to lawyers getting involved, and that leads to transaction closure. While each of these are small talking points, each phase of this activity lasts months. So typically the preparation phase I spoke about lasts like a month and a half. Identifying the investors lasts a month and a half. Diligence takes 2 months, lawyers take a month. So it's typically a 6 months to 8 month life cycle from a transaction process. And this I'm describing a typical sell side stroke fundraise transaction process. I will speak a bit on the buy side transaction phase before I come back into valuation intervention, right? On the buy side, timelines tend to be shorter because your client or your company has already identified an investment opportunity. So in that case, the investor comes to us and says, okay, I have been approached by this company who are seeking funds from me. I need your assistance in validating my point of view on valuation, process managing the due diligence process, and sort of project managing the legal and documentation part of it, leading to closure. So then again, the conversation, like it starts on the sell side, starts with a business model. So the first thing we do is, okay, what are the projections that the client has given you? Basis the projections, what is the valuation view? Now, how do you create sensitivities to the projections that the company has given you? So we end up making a business plan for the investor. We then do a whole mess of sensitivities in that business plan. For example, if it's a construction equipment company, and we did something recently there, we will say, okay, if the road sector growth is 8%, then the cash flows work out to this, then the DCF works out to this. But if the road sector growth becomes 5%, what happens to value? So we end up creating a band, and then we try to form a point of view saying, okay, what is your conviction level on the underlying revenue driver or cost driver, as the case may be, because of which, what is the valuation? And so the conversation begins there. The key note again is the conversation is never, okay, basis these numbers, this is the valuation, because that again is a half-day work. We always seek to identify what the core drivers of the projections are, or what the business case is, and basis that business case, what is the valuation, and then what is our point of view on that business case. That is how we try to build a richer sort of conversation or context with a potential investor. That's on the valuation part of it, and starts there. Managing the due diligence process, managing the documentation process, again, are very well established processes which sort of take months again, but that's the other scope of work. and that leads to sort of closure. So we've spoken briefly about what the transaction life cycle is when it's on a sell side transaction and what the life cycle is on a buy side transaction. Buy side typically tends to be faster because your initial 2-3 months of make info memo and identify investor are done. You are acting for one investor for one company. So it starts midway and sort of leads to closure. So now if I take a step back and try to understand the points of intervention of valuation in these contexts, right? In the sell side process, there are two key milestone areas where valuation assistance or valuation thinking has to come in. One is upfront, when the client approaches us and says, I want to raise funds. There has to be consensus between us and the clients on what the ballpark valuation should be. If not, we will invest, say, 3 months of work, and the client will then say, oh, by the way, I want a Swiggy or a Facebook kind of valuation. And we will know that that's not possible. So it will be 3 months down the track. So consensus building between us and the client upfront is very, very critical. And once we are convinced, the second point of valuation intervention is building consensus with an investor. So that's the entire negotiation part of it, saying, okay, we think the valuation is X, the investor thinks it's Y. How do you sort of bridge the gap, etc.? So that's an entire basket of thinking as well. That's on the sell side. The caveat is typically on the sell side process, what happens is the investor does a due diligence. So post a due diligence process, this valuation is always revisited because the investor's job is to sort of minimize value so they can valuation consensus with client, step 2 with investor, step 3 post due diligence. So that is the life cycle on the sell side. On the buy side, the first doesn't exist. You start with a valuation point of view between the investor and yourself, and post due diligence, you try to see how you can bring down the value. That's how the buy side process works. Now, to the way we think about these valuation discussions, we are not in the business of giving reports. By we, I mean the investment banking professionals community or the people who are sort of managing this transaction. In majority of the cases, we're not even CA, so we can't even give a valuation report. But even say for EY, there is a separate valuation team altogether which does the report issuance. So the way we think about valuation is consensus building, honestly. So valuation for us is a conversation. It is not a deliverable. And the entire purpose behind having this conversation is to align goals between the client and ourselves. So the way we approach every valuation discussion is trying to identify what the core levers of growth of a company are. Because as you know better than I, valuation is nothing but cash flow, cash generation at some point in time or the other. If not now, then even for a Paytm or a Swiggy or whatever, it all is how much cash can be generated 5 years from now, 7 years from now, etc. So we start every conversation with what are your key drivers? If you're saying that this is your growth that's going to come from your company, basis what are you budgeting this growth? Invariably, it's a function of 3 things: a revenue driver, a cost driver, and a capital driver. A revenue driver basically says I'm going to double in size every year or grow exponentially for the next 8 years. All our consumer internet companies, SaaS companies, everything we see in the news today is a revenue driver story. India is a booming country, internet access, so my revenue will grow like that. So the first question is, okay, if that is your revenue driver, basis what is this revenue driver? Is it basis internet penetration, GDP growth, food delivery, what? So that's the first conversation. The second conversation is a cost driver. It's more seen in manufacturing companies. Today, your EBITDA margin is 15%. You think it's going to become 25%. Basis what? Is it product mix that's changing? Is it higher value contracts you won, etc.? Third is capital efficiency driver. you have a lot of capacity. You're going to use that capacity to increase your cash flows. So you don't need to invest further capex. So your ROC is going to go up from here. So our question is, okay, basis what are you saying on this? So while the company gives us a business plan, making a DCF out of a business plan is not where we think value is generated for ourselves. So the idea is to have a conversation with the client saying, basis what do you think your business plan is good? And then we will opine saying, look, you are budgeting that your revenue will grow at 5 times. It doesn't sound right because your underlying GDP is only going to grow at 8%. So you may want to bring it down. So that's a conversation that's had. At the end of the day, we never take ownership for the client's business plan. We can't because it's the client's business plan. But we try to play the role of a devil's advocate through and through, saying, from our vantage point, we think this is unrealistic. People may push back here, etc., etc. So we arrive at what we call, and we build the business model for them through this process. So we think in a base case plan, this is the cash flow, this is the valuation. Worst case, this is the valuation. Best case, this is the valuation. We arrive at a range and we agree with the client on what the range could be and we go to market. So once
Mr. Sidharth, sorry to interrupt. How is it different in case of a startup? Like, even traction, there is no revenue. It's about, product is about to launch, but then the approach is, so that also there you can throw some light.
Absolutely. And as an aside, thank you for the question, ma'am. I please do interject. Please keep asking questions as and when, if I'm going to rapidly. So if I take a step back and relook at the framework, right? Revenue driver, cost driver, capital driver is the 3 metrics or 3 levers. At the end of the day, an investor is looking for what? An exit. So I come in at X and I exit at 10X, means it's a great investment for me. So the question is, can I get from X to 10X? In the case of a startup, the answer is resoundingly always a yes, because a startup will say, okay, today I don't have revenue, today I don't have cost or whatever. What is opaque to us as newspaper readers, but what is privy between the company and the startup and the investor is that there's always an exit case. So there's always, I don't want to take names of startups because even I am not privy to a fair amount of them. But if you have a company which is no revenue, no cost, it is guaranteed that there is a business plan that the company is working on, which says at the end of 5 years, I'm going to generate, say, 50 million users. Each of those users, I'm going to ask 100 rupees per annum. So my revenue is going to become 500 crores. Base is 500 crores. Your exit will be 10 times 500 crores. So 5,000 crore. So that is approaching unicorn valuation. So, and this 50 million users is not that much in an India context. So if you look at the population of cities like Swiggy and etc., they're valued very, very well because fundamentally there is a business case there. So the real question is, from an exit perspective, what is your exit story that's being conveyed? And that is invariably going to be a case in every single startup we are talking about. An exit need not be linked to profitability. An exit can also be linked to number of users. For example, there will be startups which say, I'm going to get users, and then somebody is going to acquire me for those users, not because I have cash flow. Or there'll be startups which say, I'm going to get customer data, and people will acquire me for that data, not because of my EBITDA. So
पीने में काम आ जाएगा, अभी मानित के लिए बन जाएगा और बाकी अंदर रख देंगे.
So each startup will have an exit scenario, which is opaque to us. What is that exit scenario is again a function of revenue, cost, growth, etc. But that is the first thing to be discussed. And I'll just pause here, Shilpa. I hope that addressed the question, or happy to spend more time.
Can we further discuss on the same thing? You said someone is going to acquire, and that's the story that we are going to talk about it. I think that's what you are saying. But principally, the future acquisition, whoever is going to come in, the business model has to satisfy at that point of time. Someone has to talk about that as well, right?
Right, Ganesh. So let me reword. It is not an acquisition, it's an exit. So the entire concept of an equity investor is that I am giving you money and I need an exit because they are not in the business of building businesses, right? Just from a first principles perspective. So an exit can come either from an IPO, it can come from a sale, which is the acquisition, or it can come from a buyback, where somebody buys you back. So the business case of the company, or what the company has to convey or convince a seller, a potential acquirer, sorry, is that I will become attractive enough to do one of these three things. Either I'll be big enough to IPO, or somebody will acquire me, or I'm going to become so cash flow generating that I'm going to give you your money back. And that is the fundamental question. So that is the job of the investment banker. That's a job of the company. That's a job of the promoter pool to convince people of this possibility. So the fact that the business model has to come into fruition enough so that a potential acquirer could be interested is the reason why investment bankers have jobs. So we have to make that information memo. We have to convince potential investors that this is a reality. Today, some of these are sort of going in sort of trends, so to speak. So there are some business cases which have become accepted fact. So consumer internet, for example, has become accepted fact. Like people do believe that internet penetration is going to go up. So any business which is linked to that theme, people are convinced about. Similarly, B2B SaaS, I think, is becoming fact. People are convinced that the world is shifting that way. So any startup which wants to play this game, so to speak, has to convince potential investors that their business is going to become scalable and attractive to a potential acquirer. So when we are getting into this conversation, it is critical for us to have a point of view on that potential exit as well. So we hear very often in any investor conversation we are getting into, what will the exit be? The investor will ask us. So we have to say, okay, look, if it's a manufacturing company, that is, you will become 500 crores EBITDA, so you're big enough to IPO. Okay. In the case of a startup, we'll say, look, you will end up with 20 million unique subscribers, so that is big enough for a XYZ to acquire you, whatever that XYZ is. Either the investor believes you or doesn't, depending on which he'll either do the deal or not. Or in the case of a roads company or a solar company or an infrastructure company, we'll say, look, we're going to throw out this much cash every year, because of which we can service a 14% interest rate. So we will get you your money out, which is the other thing. So it depends on case to case, but the conviction on the business case, building that is our job. And I'll just pause here again. I hope that covers the query.
No, I now I'm just, thank you very much. I'm asking, assuming that you are actually an advisor to the investor. The story that was put in front of you is that you will get 20 million unique subscribers, say at the end of 5 years or whatsoever, the time period. Thereafter, you get an exit. So therefore, you will get an exit at that particular price, and because of which I'm seeking this valuation. Now you are advising the investor. How you get convinced, apart from your market thumb rules today, that this is a multiple it is going in? You advise, how will you decide that is the value?
So that's the fundamental business call. So I think if I had to advise the investor, the way we would think about it is to go back to the drawing board. We spoke about three things, right? Revenue driver, cost driver, capital driver. This entire conversation is a revenue driver story. So if I had to advise an investor, I would say, look, this company is budgeting that they will get to 20 million users basis internet penetration becoming so and so, number of app downloads becoming so and so, number of transactions per customer becoming so and so, all of these things, right? Because of which there's a number of unique subscribers, number of transactions per subscriber, and the revenue, this stack sort of being built up. we'll say, okay, bases are sort of, so what we will do is two things. One is we will make a business model for the investor saying, if this pans out, you will get to 20 million subscribers with this. If GDP does not grow at this, if internet penetration does not grow at something, but it grows at a lower rate, you will not end up at 20 million, you will end up at 15 million, basis which your valuation will not be X, it will be 0.75X. So you will have to, this is your degree of confidence that you have to build. And fundamentally, you have to take a call whether this makes sense or not. So at the end of the day, the call that has to be done, the conviction, it's the investor's call to make, because they are accountable to their investment committee, not us. I think our role in this conversation is to show the good, the bad, the ugly, to say, okay, this is the landscape of possibilities. If the world works well, 20 million subscribers will happen. The world does not work well, it will be 15 million subscribers. But we think it can't go below 15 million because internet penetration cannot go below a certain rate. So we think if you aim for maybe 17 million subscribers as the end goal, you should be safe. So maybe that is what you should peg your valuation against, is how we would approach the conversation if we were advising the investor. So show the landscape of possibilities, show the potential valuation range, give our independent view on saying, okay, maybe 20 is not the goal, maybe 17 is the goal to get to, but with adequate safeguards, get on with it. We will also then take the additional hat of trying to give transaction structure possibilities, saying, okay, maybe link your valuation to a convertible mechanism, CC-based, all of that stuff. So that's the additional role that we play. But that's how we would approach a conversation like this. And I'll just pause again here. Did that help?
My apologies once again. So
sure.
I'm actually wearing a hat of a registered valuer. Okay. So now what I'm saying is there are 15 million subscribers. I'm not questioning that number. You certify whatever the number is, the decision based on which you want to value it. So now, after 5 years, as an investor in which a company I'm having it has only 15 million subscribers, EBITDA negative or negligible or whatever. Now, at this situation, now I have shifted to 5 years later. At that point of time, I am this, and I am looking for an exit now. Because so I am going to looking for investor. I am an investor now. I am looking for investor after 5 years. Because now I am to exit, right? So for my 15 million subscribers, I have to go and say, this is the value I'm seeking to all the investors. So I have to convince a story that please buy me. I have 15 million subscribers taking. So I ask a valuer, investment banker, registered valuer to value me. Sure. And a registered valuer comes in, he is to value 15 million subscribers. Yeah. One is in today's terms, use a comparative metrics. So similar number of subscribers, what's the value? It's a thumb rule. People are doing it.
Correct.
Otherwise, what's the other method? Apart from today's method of thumb rule, if you have so many subscribers, multiply into 1,000 rupees of value. How do you do? That's the question.
Oh, fair. No, I think that's more a valuation method kind of a question. So I think this, honestly, like I said, if I had to step into theory a bit, at that point in time, also, there are two ways you could approach this conversation, and sort of for collective benefit, just to rephrase the problem statement, we are then talking a scenario where there's a company with 15 million unique subscribers that has approached you. It doesn't have revenue, EBITDA, profit. You have been asked to provide a valuation point of view. So it's not a conversation about transaction, it's a conversation about what should my valuation be. In that point of time, honestly, at the end of the day, it's about cash. So the question is, what is the cash flow your 15 million subscribers can generate for you? Second is, how much can your 15 million subscribers grow to? These are your two things that you have to speak about. So if your 15 million subscribers have a certain revenue per subscriber, which creates certain revenue for you, there's a certain direct cost attached to maintaining that 15 million subscriber, which could be, say, your cloud infrastructure or data infrastructure cost, which is your gross margin. On top of that, you will have if you're not a growing company, but a static company, you won't have too many corporate overheads like sales and marketing. So you'll have adjusted EBITDA of a certain value. So you will look at what the cash flow pool of a 15 million subscribers is. And then you will say, by the way, my 15 million can become 30 million, basis which my cash flow will increase. So it's sort of like a DCF with a lot of thinking built in. You will not take the cash losses. You will identify why the company is making cash losses. Invariably, companies make cash losses for growth. So you will say, okay, if I remove all the growth OpEx, what will be my steady state cash flow from my subscriber basis? What should my value be? That is method one. Method two would be a comparable, like you said. For my revenue or for my subscriber base, other companies are valued at this, say 15,000 rupees per subscriber or 20,000 rupees per subscriber. So I should also be valued at that. Basis this, there's a range. So this is what I will convey. So if you were if I were a registered valuer, this is the kind of discussion I would sort of do. But the perspective I want to convey is that again becomes a valuation discussion rather than a transaction discussion. So the way we would approach it is never to give a valuation point of view in isolation. We would try to understand, okay, if you are seeking an exit, who should a potential investor be? How much should a potential valuation range be? And sort of take it from there. I think that's how we would go about it. Does that cover, Ganesh?
Oh, thank you, Sidharth. Thank you very much.
Yeah. So we've spoken then about typical transaction sort of life cycles on the sell side and on the buy side. We've spoken about how valuation intervention happens at the outset, which is at the beginning of the transaction. And sort of to take a step back again, the way we've spoken, the way we would approach a conversation like this is by looking at the levers: revenue lever, cost lever, capital lever, with the perspective of exit. So which of these levers have to kick in for an exit to happen? And that then is the framework. That is the story that we will seek to build for a potential investor to come. And that's where all the dressing up of the company, the ideation, all of that happens. The next thing I would like to speak upon is where we typically see registered valuers sort of entering this movie that we've just outlined. But before that, I'll just pause. Are there any further questions I can speak about before speaking about registered valuers today? Or I'm happy to move on to that if there's no questions at this point.
So, Sidharth, hi, Sanjay here. Question.
Yes, Sanjay.
In the real world, when we are seeing money getting exchanged,
right,
and as we talked about a startup where there is no revenue, no EBITDA, etc. And we have a similar comparable company like another 50 million users getting sold at about $5 million.
Yeah.
So do we take that as a benchmark and then proceed? I mean, does the investor get convinced? Yes, find the users. We will get the users, and this it's good to put in the money. I mean, what do they think when you are sitting in the table and discussing? What do they think?
So in real life, there's always a competitive element also. So there is a lot of, so if the sector is hot, investors will just do the deal. But in a more, that's not always the case. So the way we try to build conviction is on two things, which you already identified. One is the fact that I will get to a certain user count. Second, and that's the core of the story. 90% of the effort is to convince people that I will get to the goal that I am talking about, not my valuation. So I'll have to tell people, look, I am a no revenue, no EBITDA company, but I can become the Tesla of this industry, or I can become the Geo of this industry or the Swiggy of this industry. Actually, 99% effort is only on that. So there people will look at the quality of the team behind the startup, whether they have done something like this or not. They will look at the macro environment. They will look at the underlying revenue drivers that we spoke about. The conviction building is only on that. If they are convinced that we will get to 15 million, then the rule of thumb you spoke about is a very simple one. Saying, okay, this company with lower user base is valued at $500 million. You are convinced that I am a far better pedigree than this one. So why should I not get $600 million as valuation? And if you don't do it, somebody else will. That's the last element. So build conviction on the business case, use the rule of thumb, comparable and competitive. That's all there is to it.
Right. I mean, so in our case, what we valuers are taught, I would say, that look at the numbers only and don't go about doing all of these things. Correct. What the promoter's conviction is, or how convincing they are. We don't do that. An investor would do that. And so I believe that is missing in our valuation exercise completely.
So actually, that's one of the things I wanted to touch upon. It is not my place, and neither do I have the level of gray hair or the competence to comment on registered valuation practices today. But from a transaction perspective, the lacuna that I sense is that valuation, as we see it, is not a point in time exercise. Very rarely, if a company is seeking a valuation report, if they come to us, we don't even have the competence to issue a valuation report. I'm talking about investment banking professionals, myself. We see it as an excellent gateway to a conversation, because a valuation report will maybe give us a few lakhs, but if you pull off a fundraise process and structure a success fee, we are talking fees in double-digit lakhs or crores. So that is the game that we try to play, and I'm being very candid, hoping this is a closed forum, but that is the sort of drive that we want to sort of get to. So we see it as a conversation saying, okay, you want a valuation report. Why? You want to raise funds? Okay. How much? Okay. If you want to raise that much funds, we think you should be looking at lesser funds or more funds. And if you want to raise that much funds, this is the story that you have to portray. For this story to portray, you have to emphasize this. This we will do for you. And this is basis this. By the way, this is a valuation. This is the info memo. This is the business plan. And we take it from there.
What happens if there's a conflict? I mean, you're not convinced about the guy, but would you take
that? No, I mean, that's a very, 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 very case-to-case thing. Honestly, that's where we end up with disconnects upfront. So we tell a guy, okay, we don't think you can grow at 5x. So if it's a company which is selling bearings for automotive, for example, not to disparage that industry at all, but that's not an industry which is going to triple every year in terms of revenue. It will be a 20%, 30% growth story if it's a great company. 300% growth is never going to happen in a manufacturing, that kind of industry, in my experience. Then we'll say, okay, your projections are unrealistic. We don't think an investor will agree. Your numbers remain yours, but you're going to have a challenge. And then we try to hash that out. Because it's a waste of time otherwise if we go to an investor with those numbers.
True. Thanks.
Here, I would like to add a few points. Okay. Say, for example, were there any chance that you were questioned by the investor wherein you were an investment advisor? Okay. More or less, he relied on you, especially a foreign national. Okay, because they take things very seriously. You give an advisory or you give a report, you have to mean it and you have to justify it. That might be the understanding of a foreign national. So was there any such interaction wherein the investor held you accountable? Okay, you came out of it, that's a different story. Okay, so was there any such instance, and how, does that happen to you or your other team? May not be your division in EY, but some other team. Any allegation, any interaction wherein he said, your advice was baseless, your valuation was baseless, the promoters, you colluded with the promoter, and I am ending up with whatever, or the promoter was a fraudster, or any such instance. I'll be happy if you can share, so that we are better equipped to face a similar situation.
No, absolutely. That's a very important area that you raise, man. So, and maybe I'll speak on some of the safeguards we take to towards that, because nobody wants to be in a situation like that. So the first thing and very important thing that we always emphasize, and I think I've maybe alluded to it a few times in this conversation as well, is the numbers are the company's numbers. And we are express about that in every conversation. If we are saying, and in all our documents, there's a 3-page disclaimer. And there's at least from my organization, there's an entire risk team whose job it is to ensure this, because, and that's fair also. We cannot guarantee a company's numbers. We are not audited. An audit team, you would know better than I, has an entire different, it's a completely different conversation. We are not an audit team. We don't audit the company. So any financials that the company gives us, we are relying on. So we make it known to every investor that, look, the numbers are the company's numbers. We are not giving you investment advice. We are conveying the company's point of view to you. And while these are just words, each word is very important. We are not relying on company's numbers is a very, very loaded statement. That means it's a company's auditors, it is the company's numbers, and the projections are the company's own. We are just organizing the data and presenting it to you. The important difference between, I think, what you're encountering and me is I don't give a written deliverable. I don't give a written report ever. Whereas a valuation team inside EY would be giving written reports. So I'm not sure what their caveats or what their disclaimers look like, but I'm pretty sure they have literature around that as well, saying that basis these numbers, which you have to build conviction on, this is the valuation point of view. So I think the key thing we try to emphasize is that only that whatever we are conveying is a company's data, not us. You can't treat this as our investment advice. If you want to do so, you have to have a separate independent agency doing it. And in the real world, blessedly, I have not personally had any issues where the situation has gone sideways. It's well understood. So every advisor does their own diligence and things unfold as the case may be. So I think this sort of protocol holds up in the real world as well. I hope that gives you clarity onto that question. So just to move forward, so we've spoken again of the transaction life cycles, and I hope we now have a context, right, in which to talk about further things. So in terms of where we seek registered valuer assistance today, when I say we, I mean in the transaction persuasion, either if I'm on the sell side with a company or on the buy side for an investor. Unfortunately, registered valuer valuation reports are pretty much only sought towards the end stages in most transactions. I'm not talking about buybacks. I'm not talking about M&A, sort of mergers, demergers. All of that is separate. In a fundraise, acquisition, M&A conversation, we see registered valuer certificates being sought once the dust has already settled. Once the buyer and seller have shaken hands on a transaction, once the transaction is about to close, when shares have to be issued to a company, we need a start valuation certificate from a FEMA or an income tax or whatever perspective. That is when we see, when we approach registered valuers and say, okay, can you give us a valuation report? These are the numbers. This is the valuation that is being sought. So that is invariably the use case that we see. The potential issue with that is it becomes and wearing the hat of a registered valuer, it becomes very low engagement transactional discussion where you say, okay, give me this is my report, I will charge you for report. But there's a very rich fabric of valuation conversation that's already happened in the background. Upfront with the company, with the investor, post diligence, etc., which we think potentially valuation agencies are missing out on. because from a valuation report perspective, valuation reports are not needed there. So the way, and this for me is the biggest potential gap that valuation professionals may want to look at. So I think if there's one key thing I'd like to emphasize maybe today is that we try to avoid falling into the transaction trap, as I call it, is we ask questions, and we, like I said, every time a valuation concept comes up, we try to make it a conversation, and then we try to solve for that conversation. So the value add that we try to provide is a stress test on the business plan of the company itself, valuation as an outcome of the business plan, and how realistic is that business plan. And that's how we try to build a larger conversation, and that can get into offshoots like, okay, we will help make a business plan for you, or we will help look at sensitivity analysis for you, or we can even try to help you with a market report or stuff like that. And that's how we try to build a larger scope of work, basically. And that is how we think potentially valuation agencies today can get into larger advisor territory through sort of these levers. And I'll just pause again with this.
That's the challenge, Sidharth. That's the challenge, Sidharth. What happens is, incidentally, as an investment banker, you would have come to a conclusion on the valuation. However, so it's a good storytelling. It's like a Rajamouli making a movie, Bahubali, and is making money. You do that.
Yeah.
But when a valuer has to give a report, he has to look at the facts, and so his value will be nowhere near the number that you have, because it's a storytelling. So valuer will be it's impossible to get closer to that valuation that probably you are getting it.
Yeah.
And okay, the individual contractual agreement can be at whatever price, doesn't matter, as long as the price cannot be below. But when the parties seek a valuation report closer to the number that they have agreed upon, that puts pressure on the valuer, because valuer, if he is not convinced, he cannot give it.
Yeah.
And there's a huge gap in that at this stage.
Yeah. So I think honestly, the storytelling honestly is always predicated on facts again, because and that's sort of imperative. Now, if I have to sort of wear that hat, if somebody presents me with that story, then the conversation, the first thing that I would like to, what I would do is to understand, why is the story the story? If somebody has come and painted you the picture where Bahubali has won, you'll have to ask him, okay, who did he beat? Who is Bahubali? What kingdom is this? Why did he beat, etc.? So in a more serious tone, the first thing I would do is to understand, okay, if you're giving me these cash flows, basis what is this cash flow? If you're saying, and this is invariably something, typically who will come to you with a valuation report query, either the company or an investment banker or the investor. Each of these three characters has already been privy to the story. They've either sold the story or been convinced themselves of the story. So the first thing that I would ask them is, okay, if you're asking me to stick my neck out for this, internet penetration, is it app downloads, is it value per user? How is this revenue driver happening? How is this cost driver happening? How do you think this outcome is happening? You cannot challenge them too much, because they will go to somebody else if you push them too hard and say, I will not issue a valuation report. But the idea is nobody is at the end of the day giving free money to anyone, right? There's always some committee somewhere that's being convinced. So I would stress a lot to try to understand what those cost levers are, or what those revenue levers are. And whether to include that in a valuation report or not is not my area of knowledge, forget expertise. But if I had to understand valuation, I would do that in a transaction context. Because 100% there is a memo somewhere. Somebody has already made a business plan. Somebody has already made an IC note where this has already been covered. So that fact will always exist. So you can safely ask people, okay, what is the user count you have assumed, what is the market growth rate you've assumed in your internal. People should be able to help you with that. That's at least how I would think. But yeah, so sorry Ganesh, I was just reacting to more observation from you, but yeah, I think that's how I would think about it.
Hi Sidharth, Uttam here.
Yes.
When the actual value discovery is done and the transactions have, it's close to getting consummated, and you, at that point of time, when you go to the valuer for the valuation report, are you looking for the exact figure, or is it the approximate figure which you are looking at, which is near to the value which has already been discovered or agreed to? And if that's the case, if there is a small difference, are you finicky about it, or you just basically go through the transaction? How's it? Because face a few cases where for these fractions there is a lot of heckling being done.
Oh, that's a bit unusual, because the second thing, so we've spoken about two things, right? Registered valuation assistance is sought because there is paperwork needed for SEBI or FEMA, not SEBI, FEMA or income tax perspectives. So basis that either I need to issue shares at greater than FMV or lesser than FMV, depending on whether it's India resident, non-resident, etc. So it is never, ever, in 99% of the cases, needed to be exact, because it needs to be a greater than or lesser than, it needs to be either lesser than the agreed price or greater than the agreed price. So it will be useful maybe for, in that conversation, for you to convey that as well. Is what, if I was speaking to a registered valuer and the valuer told me, boss, you don't need it up to 2 decimal points because this is a resident to resident. So you need it higher than a certain number. So even if it is 0.23 lesser, or if it's rounded down, it shouldn't matter to you. As a person seeking it, I'll be happy. I'll be like, oh, awesome. I didn't know that. Cool. So it is, I don't think one ever needs to think about it from a double decimal point perspective. I think it's more a prescriptive thing, whether it's higher or lower. This is in the case of a regulatory requirement. Now, you will also have scenarios where in most agreements, parties say, okay, we will ask a valuation firm to come and break a deadlock for us. If that is the case, then you are in a rough spot, because there people will argue for double decimal points, because it's no longer regulatory, it is commercial, where people are relying on you to break a deadlock. There, the conversation should be as facts and figures as possible. There, the way we do it is to say, the two parties are arguing for a valuation report, and you are on the hook to give them that valuation number. Each party is arguing for lesser than or higher than, say, double decimal points. So the way I would do it is to divorce valuation from business case, and I would say, okay, my valuation is because of this business case. If this business case is holding, then this is the valuation, full stop. You guys agree on the business case, and that is something I can't comment on. I think it is higher or lower, but if the business case is something you're convinced upon, this is arithmetic. And that's how I would break that deadlock and sort of move forward. So I'm not sure, Uttam, if I was able to cover the points that you raised, but that's how I would think about it.
Thanks, Sidharth. Thanks a lot.
Sure. So from our overall, then, when we started this conversation about an hour ago, and the things that I sort of wanted to touch upon are the typical transaction life cycle, which is on the sell side, on the buy side, which I believe we've done. On the valuation stages, we spoke about at the starting point with the company, we spoke about at the investor thing, and at the final sort of post due diligence phase. We spoke about registered valuers today, which is the point where we seek a valuation report and the lacuna there. And finally, on validating some of these conversations, revenue driver, cost driver, capital driver, and exit. This is your three levers, and then outcome. This is your larger context. Every one of these is what we use as a topic of conversation. So honestly, while it's been only an hour, I think this is sort of the context I wanted to sort of convey to you all. And from an investment banking perspective, what we try to do is to make it a larger conversation where we cover the spectrum from a well-meaning guidance perspective, maybe, and this is basis the interaction that I have had with registered valuers. It will be useful for us if the valuation advisors, valuation providers also become valuation advisors, where they tell us two things. One is the thinking about the business case. Second is thinking about regulations. So if a valuation advisor were to tell me, hey, you need a report, okay, the FEMA guidelines are this should be the value. If you do this, you're fine. I would be thrilled. Or if a valuation advisor tells a company that, okay, you want a valuation report basis this business case, okay. But if this business case doesn't happen, if it becomes half the business case, this is your value. So you may want to think about strengthening your conversation on this revenue case. The company would be thrilled. So how do we upscale that conversation from a valuation as a deliverable to valuation as an outcome of a business case conversation would be a sort of critical parting thought, I guess I want to sort of leave today with. And I hope I've conveyed the larger context in which all of this thinking is happening. And I'll just pause here for questions or any other further conversation areas.
This is Sundaraman from Chennai.
Yes,
the biggest challenge for a valuer is demonstrated in a way. If you see Zomato, the way it was valued and it got listed at a different price. But in the case of startups and other things, we don't have a market to distinguish between price and value. So this is where valuers get a lot of flack, I would say, or even a lot of scrutiny, because there is no distinction between a price and a value in the case of. And say for a Zomato, I can always do a valuation and say that this value is this. But the price could be different in the market. But in the case of startups, or in the case of a transaction advisory, when you do a buy side, sell side, where there is no market as such, the transaction advisors as well as the promoters insist that the valuers should give a value which is near the price. This is where the challenge comes to us. How do we distinguish that in a valuation report? Say it is not for regulator also, you think, in the typical case which you were referring. Let us discount the regulator. Where can I make a distinction between the value and the price, and why the price is different from the value? See, when I write an article, I can write about Zomato. This is the value which Ashwath did, and this is the price at which the difference is on account of ABCD factors. But in a valuation report, I can't do that. Now, how do we distinguish between price and value in the case of these startups?
No, excellent questions in there. So honestly, startup valuation is a big question mark for half the world, if not more. So the way I would, if I were, if a transaction advisor or a company came to me and said, I want a valuation report to say 1,000 crores randomly, and suppose it's a pre-revenue, pre-whatever company. There's two questions, right? One is, do you already have an investor in mind that you're trying to close a transaction with, for which you're asking for a valuation report from me? Or basis my valuation report, do you want to go out and convince an investor? Now, these are mutually exclusive, completely exhaustive kind of conversations. So if you already have an investor who has agreed to a price, or you're trying to convince an investor, or rather, we'll come to that separately, but you have an investor who's agreed to a price and you're seeking a valuation certificate from me, then it is a function of saying, okay, you give me your business case, basis which you have convinced your investor, and what is the reason for this business case? So I am not honestly conversant with the regulatory requirements behind the valuation certificate, because that's not what I do. But the way I would think about it is that there is a business case which would exist in that conversation, which the company and the investor have both signed off on. Business case could be as simple as saying, I will go to 100 million subscribers by 5 years. As simple as that. And at that point in time, each subscriber is worth 1,000 rupees. So my value should be whatever, X thousand crores. So I would seek from the company the business case which has been convinced or conveyed to the investor and people have signed off on. And I will try to include notes on that business case. So it's not qualitative. A business case is very factual. What is the subscriber count by year for 5 years? What is the average revenue per user? Basis which what is revenue? Basis which what is cost? And your projections follow from there. So it's just adding lines above the revenue projection, the assumptions behind the revenue projection. And some qualitative notes saying company is projecting a revenue increase of say 50 times because of internet penetration and average revenue per user going up. And I would sort of leave it at that. So if this is a valuation conversation where parties have been convinced of the price, I would go down that path without again commenting on the regulatory sort of implications of a valuation exercise. If it is a latter where the companies come to you and say, give me a valuation report where I'm going to use your valuation report to convince a potential investor, then it is a larger conversation, which is what we spoke about earlier, where you will have to build that business case for the company. And you will have to say, okay, if you are going to try to convince somebody that you're going to become 50 times larger than you are right now, basis what are you going to convince the company? What are the macro drivers that you are budgeting? And then it's a larger scope of work for you. You can't give just your valuation report and expect the company to be happy with that. If I were you, I would convince the client saying, look, this is a simple valuation report will not cut ice. You will need me to comment on the business case as well, which is a larger conversation, which is a larger info memo. So, and that sort of raises a larger conversation from there on. I don't know, Sundar, if I could convey my thinking around that, but this is how
I could understand the context and the way you have put it rightly. One more issue that crops up is, see, a transaction advisory starts with the sell side, buy side, and once the transaction is closed, the transaction effectively comes to a close. Then the investor and the company continues. But the registered valuer or the valuation which has been done continues to be the guiding factor over the period of the transaction. But sometimes what happens is the valuation drivers which you had taken for valuation could undergo change itself because of the market or so many other things. Now that leads to the next question. If my valuation driver has been completely lost, or some other driver, say for example, you had gone by the number of subscribers, but then ultimately it went into number of transactions sort of thing because the subscriber didn't. Now the valuation driver changes from the subscriber to the number of transactions or downloads or whatever hits or whatever it is. But the then the next when the investor again wants to exit, now he can how does the valuer say that in upfront itself that these are the number of factors. Currently, I have taken this valuation driver. It could undergo a change. Should we have some sensitivity analysis or any such things in our valuation?
You absolutely should, I would think, because the world changes. I mean, today there's a technology which exists and companies are raising money off the technology. Tomorrow the technology could die. I mean, I'm saying, I'm speaking loosely, but if there's some environmental regulation against lithium-ion batteries tomorrow that we don't know about, which could harm the EV industry, we don't know that today. So you're absolutely right that valuation is a very point-in-time exercise. The same business case is a very point-in-time exercise. The core macro fundamentals of any economy change over time. So, which is why I would preface every valuation discussion report conversation saying, this is the business case. These are the drivers of the business case. Basis these drivers and basis this business case and management commentary, this is a valuation. 4 years from now, if you are asked to revisit, you will say, okay, this is the business case today. If somebody asks you to comment on why your number today is different from a number 5 years ago, you can say again 3 things, right? Drivers of business case, the case itself, and the valuation as an outcome. So my drivers are different today, or my business itself is different today. I have pivoted, basis which my valuation outcome is different today. So I would treat valuation as the arithmetic outcome of a business conversation, and the business conversation is a factor of the company's business model and macro drivers, which are always dynamic. So how I would include that as in a report is not my area to comment on, but in a conversation, absolutely. I think these are the things I would touch upon. If you can include them in a report, nothing like it, I would think.
Sidharth, Nataraj here.
Yeah, Nataraj.
Yeah, please go ahead.
Yeah, my question is, see, there are scenarios wherein there is a market penetration strategy is in place. However, there could be a prototype product in place, or there is no product also in place. So in both scenarios, if at least the product is there, then there is more reliance on the market penetration strategy. However, if product itself is not there, it is all made up and it is coming from the books. Yeah. So how do you really analyze this kind of situation? Because I can also make a business plan and project report and all those stuff.
Correct. No, so I think then you're talking pure business school, Excel sheet, DCF workings kind of a thing. So I don't think you will be able to comment, or when I say you, I mean any of us will be able to comment on technology as technology efficiency or efficacy. I mean, I don't know if I personally have the wherewithal to say why a technology will succeed or not in a certain market. So honestly, then I would treat it again in my 3 layers that we spoke about, Raj. One is the framework we spoke about was the drivers of a business case, the case, and the valuation outcome. I would say, okay, this is the business case that the company is saying. Product will succeed, market will take up product, and we will grow. Basis this business plan, this is the valuation. Please note that the business case is a function of these 3 assumptions. I would then put sensitivities there. If these assumptions do not succeed, if we achieve market penetration of half what we have budgeted, if our product takes 3 years to kick in and not 1 year, then my numbers will change and then my valuation will also change. So then this is a conversation I would have with the client before putting it in a project report, or in a project report fair, but in a project valuation certificate. I would say, look, you have given me a business plan, but these are the sensitivities. If you ask me to give a valuation report, I'm going to put a big asterisk and say, these are the, just like you see DRHP documents, where they caveat everything. So these are the risks: technology uptake, market penetration, etc. If you're convinced of these risks, this is the valuation as an outcome. So I would treat the outcome as an arithmetic exercise, and I would de-risk you or de-risk us from commenting on that logic. I would say this is the business case's outcome, and I would treat it from there. But for a conversation with the client that comes to you, the way I do it typically is to say, okay, you've given me this story. These are the sensitivities that I foresee. I would go the extra mile and say, okay, in my desktop research, these kind of products have not really succeeded this quickly in other markets. So are you really sure this is the kind of plan you want to portray? Because an eventual investor will ask you the same questions and you will be stuck then. So why don't you temper down your assumptions slightly? Or why don't you pause this entire exercise before you do a proof of concept? So that leads to a larger advisory kind of discussions, which at least I personally found that clients always appreciate. So I would put the arithmetic and basis the arithmetic lead into a larger conversation.
Yeah, makes sense. That just one small question to just conclude this is that see, if the company is in growth stage, I think is one situation. However, if it is at a seed stage, then would you really after analyzing the factors, would you also say no to the valuation? Is that something, a decision which is required to be taken, that if your business plan is not okay and I'm not convinced, I'm not ready to do the valuation or something like that? Is that something we need to take a
Not
call?
at all. No, I don't think so at all. Because at the end of the day, nobody is asking you to stick your neck out. When I say you, I mean all of us. Nobody's asking us to stick our neck out for a business case, especially at seed stage. Nobody will expect a fund or an investor to take our reliance on the feasibility of a business plan. And we'll have to be very important to convey to people that we are not commenting on the feasibility of a business plan. Sometimes it's a function of the team also. You can have a rock star team of people. Tomorrow, if Elon Musk quits everything and tries to start a new company, nobody is going to ask him, you don't have a proof of concept, so I will not give you a valuation certificate. People will know that, okay, it's Elon Musk, he's done it 7 times, he will do something. So, and if at the end of the day, if we turn down valuation business, I'm pretty sure, I mean, we live in a competitive world and we have bills to pay as well. So I don't think that's an easy conversation to have. So the role I would play is to say, look, A, I'm not commenting on business case. It is your business case. B, if you ask me, your business case will likely not be accepted by potential investors. So why don't you tweak it down? Why don't you modify it? Why don't you do 1, 2, 3 things? And then try to look at your valuation as a process is a conversation I would have, but I would never turn it down. If the client insists that I don't care, you put your caveats, basis your caveats, give me a report. I'll say, okay, basis all of these caveats, this is the outcome. Because valuation then is an outcome, an arithmetic outcome of a case that you are sticking your neck out. So that's how I would have that conversation.
Thanks.
I have a different viewpoint on this, Sidharth. So basically, recently I got the business plan. I felt it was flawed. Okay, because say for example, it was like for example, I want to join my daughter to a particular college. I would like to know everything about that college, and more so hostel. How is the hostel? How is the college? How is the coaching? Everything. So this is what is this app for? This app will help me to connect to the seniors of this college, so that I get to know everything. They have just out of the college, so I could know everything. But my main point or my personal thought was that Indian mentality is to approach somehow someone who has done that and not pay for it. I have not been, grown up in a situation where I'm paying for an advice, especially this kind of advice, wherein everyone is free to help. I just have to put a thing on WhatsApp group. Do you know anyone who has come out of this college? I have never thought of paying. Okay, even if I think of paying, how many times will I pay? And how many of, my fellow friends who are intending to do the same thing for their kids, how many of them will pay? And since the money charged will be less, say 10 rupees, 1,000 rupees, 2,000 rupees, how much will the other person get? Suppose he's really good in advising, and he can always share over a conversation his contact details, wherein he can take away a part of business. And how many volumes I have to generate so that this, and they had expressly said that we do not have any tie-up with the college. So that revenue model is gone. So I purely told him that I will not be able to do any valuation for you. There is a basic flaw in your business plan. Yeah, but if you change your strategy, get a tie-up for any college, and college revenue could be more, reliable or constant or something like that. But then he said, again, I'll be more, I can't be impartial in my advice. So I was so reluctant to give, because I couldn't see any value proposal or, the scalability to the extent of giving, a fancy valuation. Of course, all these will not come to EY, so you will not have this problem.
No, but I think that's $1 million feedback, man. I think that's exactly the kind of conversation that we would have liked to have had with that company as well, because for them, it's a simple matter of giving a few rupees and getting a valuation report. But what's the point of that valuation report if nobody in the world is going to agree? So I think that's exactly the kind of conversation I would advocate as well. And that's the exact conversation we would have with a client as well. Saying you want a valuation report, great. For a fundraise, okay. But your business concept doesn't make sense to me. Why don't you relocate it and come back? So I think that's
exactly my suggestion. One more personal suggestion I gave him is, this time you may be able to convince everyone because it could be your family, friends, or a known person. But the next round of funding, you will never be able to get it, because that time it will be even more complicated, even more challenging for you to justify your numbers.
Exactly. And I think, in agreement, I think that's the kind of conversation I think we would advocate as
well. Sidharth,
yes,
I know most of the conversation is you talking to the buy side where you are trying to tell and guide. I would like you to take the hat of the investor side. So I think sell side, you were talking about the sell side. I'm saying other way around. I would like you to talk at the investor side. There's a plan. Investor is asking to discussing with you to give him a guidance whether he has to buy at a particular price. There, the decision is largely to decide on a price, whether it is fair, not fair, what's the take, and apart from that, the due diligence. So how do you communicate to the investor this appears to be fair as a price? Part one. And second thing is, how many times, apart from probably the market transaction multiples, you as investment bankers are convinced about this just revenue driver of a consumer base, forget about profitability, as the basis of making those investment decisions?
Perfect. So maybe I'll start with the first part of that. So if you're on the buy side, which is if you're advising an investor, those are the easier conversations to have actually, because there is no story building to be done. You already received the story. Now you have to analyze that story. So very tactically, what the first thing we do whenever we are on the investor conversation is to receive the business plan from the company, and we break it, and either we remake it if we have to, or if it's already done, we break it into what the core assumptions are in the business plan, and basis which the outcome cash flow is sort of coming in, and valuation is a function of that outflow. So for instance, if the business plan is saying I'm going to grow a certain subscriber count, basis a subscriber count, this is the revenue, and this is the multiple I'm giving on the revenue, which is my valuation. So the first thing we do is I get this all on Excel, then we create scenarios and sensitivities without even commenting on anything at this point. We just create scenarios saying, okay, if my internet penetration doesn't go by X, it goes by Y. What will my revenue be? What will my value be? If my value per user doesn't go by X, goes by Y, what's revenue? What is value? So for 3 or 4 fundamental scenarios, we see what the valuation is as a data table, as an outcome. That is step 1. Step 2 is we then try to have a conversation with the investor where we're saying, okay, you are not taking a call on the business plan. You are taking a call on 3 things: that the India economy will grow a certain way, that user behavior will grow a certain way, and that the team will be able to execute on this plan. This is your equity call that you are making, not that DCF discount rate will be something. For these, we will say, okay, how do you substantiate these points of view? Because the investor is always answerable to an investment committee as well. You will substantiate this by looking at past data. Okay, if internet penetration has been going like this, but you assume that it's going to go like that, there is a disconnect. So basis past data for each of these assumptions, what was the trend in the past? What is the projected trend? And is there some semblance between the two? So we create the data table exercise, then we try to build point of view on each of these assumption drivers, largely by correlating with the past data. Some are qualitative, like quality of team, etc., which you can't comment on, which the investor just has to agree or disagree. but we try to break it down and come to a range of outcomes or a fan of outcomes, which says, okay, this is the base case valuation, this is the worst case valuation, and this is when we think you're going to end up somewhere in between. So this is the initial valuation conversation that we have, saying basis these points of view on the revenue drivers or growth drivers, we believe this could be a reasonable valuation. Now, the job on the investment advisory side doesn't stop there, because then you have due diligence. In due diligence, we try to verify each of these revenue areas. Yeah, so for example, we've done large deals where the entire focus of the diligence is on macroeconomy, where if cement is growing at a certain rate, if GDP is growing at a certain rate, what will cement consumption be, because of which what will road construction be, because of which what will construction equipment requirement be, for instance. So these revenue drivers that we speak about, or the valuation drivers, become the subject of the due diligence process. So either we get an external agency to come in, or we help out ourselves. Each of these are either verified either through a commercial due diligence or a financial due diligence, or even a background check on promoters. And we project manage all of that. And then at the end of the DD process, we reconvene on the valuation part of it. We'll say, okay, these are the valuation drivers and sensitivities. This was point of view on each of those drivers, because of which this was the reasonable valuation outcome. In due diligence, we have verified this and we have revised our point of view. So we think the final outcome you should underwrite is X. And that is the final valuation which is sort of plugged into the investment committee note, and which we sort of then either agree or disagree with the promoter and get on with. That was a long-winded answer, Ganesh, but this is the process of it all. I hope that conveys thinking on that.
Thank you, Sidharth. Only thing is, I was always wondering, since, for example, suppose if you are valuing an X company, and as you rightly said, you're doing a due diligence on their projections and everything, is this entirely also there is a discussion on parallel investments? So, for example, Zomato, they made a venture capital investment in some other companies. Is that part of typically your business case? Most likely, does it happen? Such kind of investment decisions in future after raising capital?
Good question. So two parts to that, and this is again just very factual. If I'm raising money to make investments, if that is what I'm raising money for example, I think there's a startup. I don't want to take any company names today, but there's a company in Bangalore, I think, which is raising funds to acquire other consumer brands. So the entire concept is I'm raising funds to acquire brands. Should that form part of valuation or not? The answer is yes, if there is certainty on that acquisition happening, and that certainty can be twofold. One is you have a signed term sheet with the other party. B, it is a condition precedent to a transaction. C, you have taken a call that there is 5 targets, at least one of them will happen. So it will form part of valuation if there is conviction, but it will be post money to the extent. So your valuation that you're arriving at, which includes the target, will be post money to the extent of the cost of that acquisition, or the valuation that you have to give to that target. So that's how I would do it. In the case of a Zomato, because it's such a large monolith, I'm not sure honestly at what point in time. If they are already doing that valuation without your money also, and it's almost a done deal, then I would include it. And again, I would treat it as post money to the extent of that valuation consideration that has to be paid. So I think that's a preface.
Yeah, no, not to talk about specific, I'm sorry, because there are other public sector company, large company, the follow-up proceeds that they got it from the IPO was specific for a particular purpose. So the money was lying. They could not use it for any other purpose other than for that purpose. So the money. So that's why I was wondering when you do the valuation.
Yeah. No, that would be restricted cash thing. So that would be like net debt, so to speak. So you'll have a way of encountering all of that in the enterprise value to equity value. So I think, so any further questions? Because at least from my perspective, I think we've covered the ground that at least I wanted to sort of lay out today.
Sidharth, this is Gangadhar. I have a question. Normally, these definitive agreements, once the transaction is over, typically contain certain terms wherein the valuation or dilution is linked to performance or future achievement of revenue kind of things. In such a scenario, if you take that into consideration, the valuation typically comes in a range. It's not an absolute number. But however, the regulatory requires you to get into a single number. In case of FEMA, if you take that FEMA into account, it's only one number that you are supposed to give as a value. So in such a situation, how do you tackle the difference between the definitive agreement terms and the regulatory requirement?
So there, it's a fair question, another, and there I think there has to be a discussion to be had with the parties, because there'll always be a concept of a floor value. Most convertible mechanisms have a floor value. If it's already there, well and good, your problem is solved. You give a valuation report for that floor value. If there is no floor value, you will then have to speak to the parties and say, look, whatever valuation we give you in a report today, you will be hard pressed to convert at lesser than that. So our valuation number will become a floor value for you commercially. So are you aware of this? And if so, what is the value you want us to give? So it's a very, very commercial call, which the parties will then have to take. So from a registered value perspective, you just have to flag it with them. Saying
should that be included in the agreement? Should that,
if the parties are,
should that be included in the agreement?
The parties better included in the agreement, actually, because it's a
sometimes
commercial.
So as a valuer, you are supposed to suggest them to include such kind of.
I mean, whether they include or not is their call, but you need to tell things. One, whatever number I give today will become the floor for you. So it is my job to inform you of this. Now you do what you want with that information, but please be advised. You can't blame anyone later. So that's how I would treat that.
Mr. Sidharth.
Yes, sir. Thank you.
See, I have some cases. What we discussed is all this big ticket. Small tickets, the promoters they wanted to issue shares for their existing shareholders and also for a few other shareholders. They have some value in the mind. They'll give some Excel projections, no story built in as we discussed. So in such a case, whatever they've done, Excel numbers are not acceptable, and also there is no story built. Even the story is there, but not documented. In such a case, we find, as you said, valuation a little difficult. So how do you bridge the gap between the mind, what is there in their mind, and what the valuation we feel that it is correct?
I think it's, as you only said, so the fact that you think a valuation case is not right means you already have a point of view on the numbers. Means that point of view is coming from somewhere. It's either you think the growth rate is not going to be what they're showing, or the profitability will be lesser, or any of the other things. So the conversation I would have is basically go back to the business case, saying, look, you are saying you will grow at 50%. No company in the world in your sector is growing at 50%. We don't think this is a fair number. So why don't you relook at it? Whether you finally refuse to give them a report basis the numbers or not is more a personal call. But I would break it down into the core assumption behind their business case, where your point of view is coming from, and advise that, this will not be palatable, and this is what your number should be, etc. I would also look at other proxies. For example, if it's a existing industry, not a startup, I would see what the comparable companies are trading at, and I would say, okay, this is what the fair market value is. You're asking for a higher valuation, so we don't think this is right. That's and that leads to a conversation like either they convince you or you agree to a middle ground and you move forward. Did that answer the question, Chanchika?
Yes, I got it. But basically, what we are finding is there could be a story we need to build. See, promoters, they have gut feeling. Yes, this is my price, but they'll give. So, on seeing the prima facie, we feel that numbers are not correct. But once we go into little deeper and deeper, as you said, this revenue model, cost, capacities, well, then it can be justified. Again, it is a time involved process.
Yeah. So I guess as we're speaking, if I had to summarize, I mean, what are the core drivers behind the case and what is our point of view on those core drivers? Our point of view can be desktop research, it can be historical data, it can be whatever. I think those would be the fundamental things I would want to be equipped with while having a conversation with a counterparty, whether it's an investor or a client. That's what I would do.
But why is it that you are not mentioning any qualitative aspects in your entire, interaction till now? Because, we always felt that, qualitative aspects ultimately boil down to the cash flows and the numbers. But then whether in our conversations or in our backup working papers or in our actual report, how much and what exactly to highlight, whether the team matters, mentioning it is a different. I mentioned the profile of the company. I mentioned the profile of the promoters. I have an industry analysis in my report.
Yeah.
I have a point on team. I have a point is different. But then how I'm converting these to numbers, is it required, not required, the qualitative aspects, whether you do checklist method, whether you do scorecard method, on your working papers, on your report. Can you throw light on this also?
Fair point. The short answer is, the reason we don't quantify such things is because, at least in my mind, it's a binary thing. If the quality of the team is not there, an investor should not invest in a company at all, because they can't achieve anything that they're speaking about. It's all paper. So it is one of the fundamental things. So if you look at startups, since we've spoken of startups a fair bit, quality of team is point number 1 to point number 8 in a 10-point list. So if I know of my friends who are now doing a startup route, there are pre-idea funding which also happens, where somebody's quit a larger company, they don't know what they want to do yet, but a fund has come and said, okay, $10 million pre-money valuation, we will give you a term sheet. There is no idea also, there's no business case, there's no business model, but they're backing the team. So for us, team is a hugely important qualitative variable, but it is not something I would quantify as a sensitivity in my projections. I will not say I will only achieve 80% of my projections because of quality of team, because it's impossible to convince somebody on qualitative variables, I would think. So I would always say it's binary. We think these numbers are achievable because of the quality of team. And because these numbers are achievable and the macro supports it, this is the valuation. So I would lead with the qualitative variable for sure, but treat it as a binary thing. It's either a yes or no. If it's a no, then there's no point to all this conversation, kind of. That's how I would build a point of view on that. Barring team, honestly, there is no other qualitative variable per se that I would then factor in. The only soft thing in a transaction perspective is competitive intensity, which is a lot of stuff today as well. If you don't give me $1 billion valuation, somebody else will give me $1 billion valuation. So there is no logic in those conversations, I would think. There's no Excel sheet that's driving the thinking. That's more a transaction qualitative approach than anything else. But that's how, and we try to sort of steer clear in sort of talking about qualitative variables, because at the end of the day, we need to convince people and give valuation outcomes, etc. And those are more, that's heavily, completely, exclusively storytelling. If you get into team quality, I think that's my limited thought on that.
We welcome more questions from the participants. Still we have time.
Yes, please.
Sidharth, I have one more question. Sometimes what happens, the promoters, usually sometimes they miss to take more shares, and at the time of transaction setting they feel that the dilution is very much, and no, they are supposed to dilute more, and they wanted to have more shares in their kitty and at a lower valuation. So this typically happens sometimes post transaction also. Now they need more shares at a lower valuation. No, sometimes we do have to suggest a sweat equity kind, and they don't have money to invest in the company. So so the typical way out is a sweat equity, ESOP or sweat equity or a warrant kind of thing. In such a situation, even that dilution, if you take that fair market value, the prevailing fair market value, at that it results in higher taxation, right? So even the promoters doesn't want that. The typical promoters the tax amount also. How do you tackle these kind of situations in a practical scenario?
So I think I lost you in between, Gangadhar, but if I understand the question effectively is promoters want extra shares for
even sometimes see so if you take that prevailing fair market value into account, if you allot shares to the promoters at a lower price, typically they want the shares at a lower price, maybe even at face value. So in such situation, you design only sweat equity or a kind of warrant, ESOP kind of instruments that results in a perquisite tax, right? So even for that also they may not be having money. So in such situations, how do you structure the transaction? The dilution that will happen at a future date or upfront, how do you suggest the promoters get into?
Fair question, and let me try to and each of these questions I'm just trying to organize the framework and the context basis which I'm giving my point of view. So for a dilution, right, for the promoter that you're speaking about, again there's three parts to this. One is before the investor comes in, second is post the investor coming in, and third is when an exit is happening. Before the investor comes in, you just try to maximize valuation and reduce dilutions, as simple as that. Post the investor coming in, it's not easy to take ESOP or sweat equity or whatever, because any shares that you're giving yourself as a promoter is reducing the investor's shareholding. No investor in the world, I can safely say, would be okay with that. Even if you give an ESOP or a sweat equity, while the taxation to promoter may be a situation, investors also have to be okay with that. So it's easier said than done. So the way we try to resolve it is to move everything to exit. We will say, okay, there's these concepts called upside share, basically, or a promote structure, or things like that, which you see in textbooks. What we say is, okay, today my dilution is high. So for example, today investor has 20%, promoter has 80%. What I will say is, okay, if I achieve an IRR of 30% for you or 25% for you, by the time IPO happens, if I get you a IRR greater than a pre-agreed threshold, you share some back with me. So if I give you a 40% IRR by the time you are exiting the company because of my effort, then you give back some of your upside after a certain, say 30% IRR threshold back to me. Therefore, I'm recouping some of my dilution at the point of time of exit. So that is a way out that we take to bridge a valuation divide. If the promoter is concerned, that's what we do. But to answer your question on taxation, I mean, I'm not from the tax team and I would not want to comment on tax norms, but we think it's a reality. And if the promoter wants more shares, I would think the bigger concern would be the investor being okay with it than taxation. So we try to move the goalpost to exit when it's always more palatable to have such conversations. That's how we would structure it in DevNows. I'm not sure, Gangadhar, if that answered the query or not, but that's how I would think.
Yes, yes, very much. It answered my question. Actually, you can move it to exit, right? That's
pretty much. And that can all be legally agreed upfront also. So there's no confusion on that. Any further questions?
One question on this: when there is a multiple trenches are there, it may not be. So the pricing, will it be same for each trench 1, trench 2, trench 3? How do you structure, sir? Well, there are multiple trenches are there. For each trench, do you have a separate valuation, or one valuation once done, does it holds good for future?
It's all commercials. It depends on how, honestly, how far these tranches are from each other. If each tranche is happening 1 year from each other, you can't have the same valuation. So there's always a pre-agreed formula. But if each tranche is happening from within, say, 2 months of each other, there could be a different value. There could be different same value depending on how quickly the company is growing. So it's very much a commercial discussion. I have seen all cases. I have seen scenarios where tranches happening in 3 months of each other are kept at the same per share value. And I emphasize per share value because otherwise you get into pre-money, post-money territory. Or you look at scenarios where the same multiple is used. Say if it's a monthly recurring revenue, monthly revenue run rate as a multiple, then whatever is the multiple at each, whatever is the revenue at each month, that is used for each tranche. Or it's a pre-agreed number. I've seen scenarios where we have pre-agreed that today it's 600 crores, 12 months from now it will be 800 crores. Just no logic, pre-agreed. So it depends on case to case. But whatever is a formula is always legally documented. That's how we think of it. Any further questions? Or I'll summarize.
I had a challenge wherein they came for valuation, okay, and just after 1 month, 2 months, they are able to convince another set of investors whom the promoter had convinced at a much higher valuation. He said that the round which got completed was more of family, friends kind of a thing.
Yeah.
And whereas the next round, he can't afford to give a same lower level of valuation to these either professional investors or
investors.
So just in a matter of 2 months, how can any, and there is no change of facts. Sometimes that gap is 1 month also.
Yeah, I think realities are that it's entirely possible, because if I'm not wrong, the startup in Bangalore, which also went from 5,000 crores to 10,000 crores or something in 2 months or something like that recently, in terms of valuation terms. So I think business realities are, it all depends on which investor where is convinced of what. And that is something that we don't control. It's between the company.
As a registered valuer.
This is Vaidyanathan. Can I add here?
Yes, please, sir.
See, at the end of the day, it's a commercial call between two knowledgeable parties. We are most of the time provide a report largely for compliance purposes. So this scenario is not quite abnormal. 2 months valuation going by 40% or even 4 times.
Yeah. So honestly, the way in my conversations with registered valuers, what we have tended to see is that our prescribed norms are always the floors. Two parties can transact at whatever price they want at the end of the day. But the perspective of a valuation report comes in because of regulatory reasons. If you're transacting shares at lesser than a certain value, the taxman will care. If you're transacting at much more than a certain value, the taxman will care. So that's where the valuation certificate comes in. So we typically point out to, or we've seen valuers point out to us that, 2 months ago, your valuation was X. So if the valuation is gone up, you tell me what the reason is or what the business case is. Otherwise, your tax man is
no
going
reason. There is nothing.
So,
it's just that,
I know. In reality, there may be no reason. Reality, there will never be a reason for a company to double from 5,000 crores to 10,000 crores in 1 month, if I can put it that way. But you have to ask the company to help you on that. I think because commercially the parties also first need to understand where you're coming from. So what is the regulatory implication behind this conversation is the first thing I would want the value to tell me. I would want the value to come and say, look, if I gave you a 5,000 crore valuation certificate a month ago, if you're asking me for 7,500 crores today, the taxman can come at you for something. I don't know whether that's true or not because I am not commenting on tax matters. But the first thing to say is, okay, the tax authorities can come at you for this reason. They will say potentially you undervalued your shares a month back because of which is a deemed income for somebody that's gone on a month ago, because of which they're going to come at you. You should be aware of this is point number one. And whether I give you the certificate or you ask somebody else, this is a reality. So because of which I don't want to give you a 7,000 certificate for your own good.
Mr. Sidharth, we lost you for half a minute.
Okay, maybe I'll just repeat that. So the first, if a party comes at you with such a request, the first thing I would do is to outline the regulatory facts of the case, which is factual. If you get a higher valuation certificate today, people will question the valuation certificate a month ago. There may be deemed income for somebody somewhere. There'll be some tax for somebody somewhere. This is an issue that you will have, audible, man. Point number two, because of this issue, I don't think you should get a valuation certificate for 7,500 crores. You should seek one for a lower number, and it's for your own good. Point number three, if you still insist on going ahead with this, then either you'll say I am uncomfortable doing it because it is somebody will question my 1 month ago NOR, or I'll only be able to issue it at you a lower, give you a lower value report, or you tell me the fundamental thing which has changed in the business, basis which you are running the risk. So it's more a conversation to say why they are the ones going to be in a soup, not us so much. That's how I would try to resolve this situation. But this is more very touchy-feely. This is more a inter-party conversation rather than a theoretical structure. But that's how I would think could work. But that's, again, caveated is my personal approach to that situation.
I request participants also to share their views. Personally, I pass it on to a friend of mine because at least I don't want to justify two of my numbers, two of my valuation. Whatever value I have given, I have said it, I have completed, it's done. And let the other person take the baton and then let him explain if he is comfortable for that, he or she. I would also ask the participants, please share your views because this is a very common problem which each of us are facing. How did you take it up? What approach did you follow in your case?
Can I add here? Can I add?
Yes.
Yeah, see, this is a very, very important issue for valuers. See, as you said, within 2 months or without any change in the case, if the values are increasing, there is two things different. One is the transaction price. Second thing is valuation report. Transaction price, both buyer and seller, they can pay what they want the price. We have a regulatory expectation. We need to go for a fair value. So unless the case is justified between two valuation reports, that's the reason whenever we go for valuation reports, we'll see past previous valuation reports. So we need to see when there is a sudden jump in the price, either earlier valuation report is wrong or which I'm going to give the wrong report. In both the cases, whatever they say without justification, we cannot give that because tomorrow our IBBI is going to question how did, see, we are not there, very important question, we are not there here just sign the report, what give the value. As you said, we have to go through the story, understand, convince based on an independent view, then only we have to give the report. I think for all of us, it's very important that whenever there is a sudden change in the values compared to the, we need to be strong, convincible. If tomorrow IBBI asks some question, we should be able to justify. We can't give the report. And we are not there here to just sign the report. We are there to, we are an unbiased, independent valuers. So I think that's my view. So we need to be more careful when giving the report whenever there is a change in the numbers within a short period.
I think what is important is two people coming together, entering into an agreement at varied prices. It is their personal choice. Valuation need not change just because a new investor has come at a new value. Valuation remains at the fundamental. So I think one should be least bothered when new investors coming at a different price. Because earlier also when there was an investor, you were not looking at investor what is coming at. Then it becomes a participant specific value. And then if that is what you want to give it, you have to write it as participant specific value from valuation report. If it is a fair market value, which is generally about a willing buyers and the willing sellers, there is no question of you worrying about what the investors come at the price.
See, this is Vaidyanathan. What I did, either way, we can't give two reports at a so different values in such a short period of time. And on the other hand, the client says, why do you want, why can't you do it? Why do you want your friend to do it? Hot stone and rock. So I've suggested the second allotment happen at whatever the negotiated value, and MCA, you go and file the previous valuation report.
But they say that investor will never come at a higher price more than the value.
No, not necessarily, because we clearly say that this is a value which will be used by you for commercial discussion. So everything has been agreed between them. Then only they come to us.
Practically, they never use the same thing. Investors say, value, I will give that
way. I'm not saying I'm right or wrong. All I'm trying to say, you ask now, what did you do? I did this.
Thank you.
Ganeshan sir, I have one question to all the members. Now you said participant specific value. Agreed. If participant is got some privileges and also synergies, he can do that. With the participant, I do not know. The participant specific value, does it become valuation report? Can we acknowledge in the report, issue the report?
If such disclosures happen in the representation, why not? So the point is, end of the day, there is management representation. There is facts and figures in front of you. See, we are not doing anything rocket science here. We are looking at the facts and figures in front of us. If a management representation clearly states that this investor, this is the value, I am doing it about it. It's a clear representation, then there's a clear term sheet, there's a binding term sheet, there's entering the agreement. There is no harm saying that while this is the value, this is the investor is coming in. So I think somewhere, just because I like a property at a particular price, there could be emotional value for some other person and he can buy at a completely different value, right?
I do not just, I thought other members' views.
Yeah, sorry.
In case any participant specific value is considered, the same thing should be there in the purpose, MRL, our report, just in case. That's my takeaway on this conversation.
The entire geo disinvestment across Google and PE happened with a valuation difference of 40,000 crores, roughly around 10%. So it is quite logical. Again, I don't know whether they did it based on participant specific value. Participant specific value is a very, very acceptable way forward.
Can I pitch in? I also second the opinion of Ms. Ganesh. Actually, if you see IVS, there is a standard IVS standards which you are supposed to valuation standards. Typically in IVS, it was said that investment value, which is synonymous to participant specific value, which is ICA came up with the word participant specific value, whereas it was in IVS, it was mentioned as the investment value. In transaction setting, if you are conducting a value for a specific investor, that is called a participant specific value. But as a valuer, normally the valuation that we supposed to give is from the perspective of investment. So the investment company, you always conduct the value from the perspective of investment. In case of regulatory requirements, you are supposed to conduct the value, that is fair value or fair market value, in India, in an Indian valuation standard, it was mentioned as fair value. There is no fair market value. But whereas in international valuation standard, it was mentioned as market value or fair market value. If you take that, you are supposed to take fair market value or market value into consideration. That says you are irrespective of the market participants. You are not supposed to take the participant into account. You are, you conduct the valuation from the perspective of investment. So if you follow the standard and typically for the regulatory, you always take investment into consideration, not the investor. So the participant risk value or investment value is conducted from the perspective of investor. So usually these transaction settings or transactions happens from the perspective of a specific investor. So as far as we give the report, when you say that you follow the fair market value standard and going concern presumption, if you, arrive at a certain value in a certain number, you can recommend that number. The actual transaction may happen at a different price that is altogether different. So again, the Companies Act always says that it is the minimum value that you are giving. The transaction may happen at a higher value. If it is happening at a lower value, you are facing a question from a regulator, the company, even not the valuer. So this is what is my opinion. And in case of investment that are coming from far, abroad, FEMA always says that you are supposed to conduct the value taking arm's length price into consideration, and that also there you are supposed to follow only fair market value standard, not the investment value or participant specific value. So if as long as you follow the valuation standard, and if you keep the fair market value or market value or fair value standard as your basis of the valuation, then you are right in your perspective. You can recommend whatever the value that you have arrived at based on your valuation analysis. You don't have to take the investor into perspective. It is always the investment, from the investment point of view, are supposed to conduct the valuation.
I understand. In line with your remarks about statutory authority questioning it, it's already started. I'm told ROC Coimbatore. Okay, I think he happens to be a CA who understands everything better. So he's not okay with a particular higher valuation. He puts the form for resubmission. So the valuer is really in a fix, because having issued the value and being questioned about justifying the value, I don't know what steps the valuer is taking, because had he taken your point and given a value as what he feels correct, the price could be higher. That's fine. The valuer, wouldn't have been in this conflicting situation wherein he's supposed to justify a value in front of ROC. I totally agree with your point.
Shita madam, the problem is not with the valuer. The problem is the ROC. The thing is, the regulator should not have a problem if the transaction is being consummated at a price higher than the price at which the fair value. The regulator is there to protect the interest of the shareholders, and when a new shareholder is coming at a higher price, why should the existing shareholder have any problem? Of course, the answer would have been different had it been non-residents who were involved. So the problem is not with the valuer actually, or the valuation.
Shilpa, I have one more point. As Mr. Ganesh was saying, the participant specific value. Sir, Ganesh, sir, I think as earlier we discussed also, see, when we do the valuation of a company, engagement letter we get from the companies. Basically, this is done by the fair value of the company. If investor is giving an engagement letter, that he can do it, but investor engagement letter is not for regulatory purpose, that is for a commercial wisdom. So that's where our this fair valuation comes into picture. I think participant specific value, though one of the method for commercial discussion, when we get the engagement letter from the company, we'll be doing the investment fair value. Any investor, it can be X, Y, Z. So in that, Y can be an participant value, it can pay little premium. But I think participant specific value, it may not be recognized for a valuation purpose, which is for regulatory. That's what my view is, sir.
Yes, even the cost of equity that you are calculating is from the perspective of investment. The risks that are attached to the investment, not to the particular investor. when you say that when you are calculating this cost of equity or cost of capital, that goes with the investment, no, but the particular investor may be having a different risk perspective. You don't take that into consideration when you are following the fair market value or fair value standards.
Now we shall end the session. I would like to know whether all of you are interested to go into breakout rooms also. If all of you want, then we'll have a formal vote of thanks to the speaker and get into breakout rooms. Can I have on chat, whether anyone is interested? Will all of you continue now for breakout rooms, or let's wind up the session? I request Mr. Gangadhar to extend a formal vote of thanks to Mr. Sidharth, today's speaker.
Thank you very much, Sidharth. We were enlightened with valuation intricacies in terms of transaction setting, and the three variables that you have discussed were very much useful, and the things and the other aspects, the various perspectives that you have given were really helpful for us. Thank you very much, and we look forward to hear from you again in more coming sessions. Thank you so much.
Thank you, sir.
That's my side also, because I believe that it's always useful to put our valuations in the right context, because the everything is being determined by somebody else, the people who are doing the transaction advisory, and we come in only at a different stage. So it's very useful to have that perspective. Thank you for that from my side.
Thank you, sir. My pleasure, everyone. Pleasure connecting with you all. My LinkedIn profile is basically my name, so happy to connect, happy to touch base later as well. It was a pleasure speaking to you all today. Thank you.
Thank you so much, Sidharth, and thanks, Mr. Chandrasekhar, for introducing today's speaker to us. Thanks all. Have a happy weekend. Bye for now.
Take care.
Thank you, Sidharth.
Thank you all. Bye.
Bye.